We got a surprisingly hotter than expected consumer price index inflation report this Wednesday, and it hurt mortgage rates. The January headline year-over-year number came in at 3%, up 0.1%. The core inflation number, which strips out food and energy prices, came in at 3.3% year-over-year, also up 0.1%. The four main culprits that pushed inflation the most were shelter, used car sales, motor vehicle insurance, and food. I know we're all feeling these same items in our monthly budget. The numbers also got hit because of the revisions lower to the 2024 month-over-month readings that the Bureau does at the beginning of each year. This dampened the impact of the replacement values for January's numbers. You can see here in this 30-year fixed mortgage chart how mortgage rates ticked up on that CPI news on Wednesday. Luckily, we got some Valentine's Day love on Thursday and Friday. You can see in the chart how rates improved to close out the week. So what happened to create this improvement? Well, a couple of the components of the producer's price index report, which measures inflation at the producer level, were friendly to the bond market. And then on Friday, retail sales for the month of January showed a really big slowdown in spending. The headline number came in negative 0.9% month over month. The markets were expecting only 0.1% of a drop. Consumers are showing some serious signs of fatigue. It makes sense when you look at this chart on credit card debt. Look how much consumers have racked up since the end of COVID. Credit card debt is sitting at over $1.1 trillion. Yes, that's with a T, trillion dollars. No wonder why there's been fatigue in consumption. So, where are mortgage rates? Well, as of week ending February the 14th, the conventional 30-year fixed rate mortgage is sitting at 6.96%, according to Mortgage News Daily's rate survey. This is with borrowers paying approximately 1 to 1.25 in discount points to get that rate. This is the first time rates have dipped under 7% since mid-December. I know that we're all welcoming with wide open arms the sixes. I know I am. We also got the Mortgage Bankers Association weekly application survey, and it showed that week ending February the 7th, purchase applications were up 4% week over week and 2% from the same week a year ago. This wasn't a huge increase, but it's good to see it rising for the second week in a row. The positive upward trend in applications should continue and trend together with lower mortgage interest rates. Just makes sense. Thank you for watching. Join me next week for another rate and mortgage bond update. And until then, let's get better, let's close more deals, and happy Valentine's Day.